I want to talk about the differences between the Texas, let's say the major four markets.
Okay.
And let's stay with multifamily because that's what we
Perfect.
understand. So we're sitting here in Katy, we're in Houston. We know the market quite well. This is where the bulk of our assets are. And we also compete for deals in DFW, for example.
Sure.
And those two markets, in my opinion, are quite similar in their growth and in the job growth and everything, but also they're very different. There's about what it feels like twice the amount of bidding competition in DFW as compared to Houston, which results in cap rates being about 50 basis points tighter. I don't know if you agree with that 50 basis points, but yeah, can you speak to the differences that you can feel when it comes to pricing, when it comes to cap rates, projected returns, and
Sure.
things like that?
Yeah, I mean, I would say Dallas is probably a little on the richer side, right? And then, if you see cap rates that are for similar assets, right, that let's just say have similar demographics and things like that around it, why would this one be, just priced a little bit lower on the cap rate versus this one? And part of that would be they're looking at more from a macro perspective, right? If you look at the in-migration to this state, right, you do have a few more people that have been moving into Dallas, and particularly as a percentage than they are in Houston. And so from a demand perspective, there's some thought process of, well, if I have more and more people moving into Dallas, right, I should be able to, one, push rates or rental rates, in this case, a little bit stronger than I would be in maybe some other submarkets, Houston or San Antonio or something of that nature. And so I think that's part of where the premium lies, right? I would also say there's there's at least a thought process that Dallas is going to be a little bit more diverse from an employment stand base, things of that nature, and so it may offer a little bit more to a wider range, and that's why you have part of the in-migration that you do. And because of that, too, it gets a little bit more expensive there, right? And so they have a feeling that they can push more. If you look at what happened, even pre-COVID in Houston, and you look at rental rates and you look at them Dallas, and even during COVID, right, they were able to grow their rental rates more than Houston was. And so if you're able to do that, there's at least a thought process of, hey, there could be greater value here on how I can grow it, and particularly from a value add perspective versus Houston, which is just going to be more your stable. Historically, will be more stable that way. Obviously, we had a pretty large run up too, and particularly during COVID, that was outsized anything of the normal. From a rental rate perspective, but I would say that's part of where some of that dislocation may be for Dallas versus Houston.
Well, and it's interesting you mentioned growth rate, that it's a little bit bigger in Dallas, but what's also going more in Dallas, probably more supply coming to that market,
Without
right?
a doubt.
So, when you do factor things into the equation, when you look at deals, how much do you factor new supply coming up? Because the deal we did, of course, together in San Antonio, nothing being built in a 2-mile radius. Similarly, something that we're doing right now in Houston together, nothing in a 2-mile radius as well. So when you look at these opportunities, how do you handicap them accordingly? And then also, from a new construction perspective, but also how do you handicap market per market? Because a 6 cap in Dallas is not a 6 cap in San Antonio or in Austin
Sure.
or in Houston. So how do you truly analyze that? Because although it's multifamily, it's not as apples to apples like, a deal in the same submarket, right? So with all your contextual knowledge, where do you look at that and how do you kind of say yes to no to opportunities?
Yeah, I mean, I would tell you first, the way I look at it is from an investor point of view. I mean, literally right out the gate, I look at it from an investor point of view first, right? So if I'm an investor and I'm going to put my money into any of these types of deals, right, what does the investor want typically, right? So, and you can say that just from a broad perspective, an investor is going to want a greater return, right? They're going to want, it could be that they want, more cash flow versus appreciation, or it could be that they just want to know that at the end of the day, when you hit the exit, how much was my total return going to be, right? And so you're going to have those variations associated with it, associated though with the risk that you're going to take associated with that deal, right? And so it's a measurement still of risk. And so we're in a bank, right? The very first thing that I'd tell you everybody here is to do is they are to measure risk associated with the deals. So when those deals come into this boardroom, it is, have you measured the risk associated with the return that we're going to be able to get on that deal? And that's a lot of what we're asking, right? Same thing goes for the multifamily, right? It's very different deals of the deal we did in San Antonio versus the one we're doing now, right? They're different I would say they're very different types of assets, right? From a class perspective, they're very different, right? You would expect one would have more cash flow than the other, but from a total return perspective, right? Even if they are similar, right? Are you taking less risk with one than with the other, right? I would tell you one is for sure less risk, and therefore you maybe should assume a little bit less of a return associated with